Hello and welcome to Portfolio Matters, week 122. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Well, a lot going on this week. So the big news was that the Fed met and paused, although it talked a great fight, saying that board members thought a further 2 rate rises would be required this year. I don't think the equity markets believed them because the equity markets have taken off. And the Fed also revised its GDP forecasts so that it did not think the US would enter a recession in 2023. The ECB also met and raised its headline interest rates by 25 basis points to 4%. And Christine Lagarde said that the ECB is very likely to continue raising interest rates again in July. And it downgraded EU growth forecast for 2023 from 1% to 0.9%. Now, one of the reasons that the Fed was able to pause is that we had US inflation numbers and they came in soft. So CPI was at 4% and falling. Core CPI was at 5.3%. We will go through those in some depth. In the UK, we had wage numbers and they were really bad for the Bank of England. They came in hot at 6.5% year on year, and the numbers for April were also revised upwards. And the gilts markets took that very badly. 2-year gilt yields now exceed mini budget levels, and HSBC has had to raise mortgage rates twice this week. Elsewhere, Boris Johnson has been found guilty of lying to Parliament and has resigned as an MP. And China has cut interest rates and is considering measures to stimulate the economy. We'll see what they actually do. Okay, some charts related to the news. Well, this is the Fed's dot plot, and you will see that according to the dot plot, a majority of members think that 2 further rate rises are required by the end of this year. They're talking a good fight. And market expectations for end 2023 interest rates rose after the FOMC meeting, and they're now forecasting that US rates will remain at 5% or higher for the remainder of this year. So this is the US policy rates and Eurozone policy rates relative to the neutral rate. And you can see that monetary policy is now tight on both sides of the Atlantic, and monetary policy works with a big lag. So at some stage, that will start to slow the economy. And this has been an unprecedentedly fast hiking cycle, which will affect corporate earnings eventually. This chart shows a 17-month lag. Now, in the UK, the Bank of England has lost control of the yield curve. So this is swap rates for the UK, and what they are showing is that the market is pricing in 5 further rate hikes by January 2024. Now, actually, I think you need to look at this the other way round. The market is essentially refusing to buy UK debt unless it yields 5.7% by January 2024. So, as we have said many times in the past, if the Bank of England doesn't raise rates sufficiently, the market will raise rates for it. And that is precisely what's happened. 1 year UK yields have gone up and tightened UK financial conditions, and that has been out of the Bank of England's control. So this is UK interest rate expectations as taken from those swap rates. And comedy chart, Richard always appreciates these. This is the ECB's inflation forecasts.
I have to say, where's their latest inflation forecast, Keith?
Well,
Oh, we just draw it in, don't we?
yeah, well, you only need a ruler, 45 degrees. They all end at exactly the same point.
Yeah, easy, yeah.
And this is Oxford Economics forecast for base rates. And can you see they are forecasting that in 2024, the Fed and the ECB will be able to cut rates. The Bank of England will not.
Something a bit dodgy about that chart in that you think they forecasted them very accurately until you realise that the forecast is only a bit on the tail end.
Yeah, no, well, absolutely. But frankly, UK interest rates have shot up, and that will slow the economy. Essentially, the flip side of the UK having an inflation problem is that the market has raised rates to the point where a recession is inevitable in the UK. It may not be in the US, but it certainly is in the UK. And equity markets have taken the Fed pause incredibly well. And yesterday saw the largest call volume on the S&P 500 in history.
It would be interesting to see what the dispersion of that is across the S&P 500 keys in terms of, is it still NVIDIA and Apple basically, or is it a few others joining the party now?
Well, it has broadened, Richard, but NVIDIA, we've got a chart on NVIDIA later. NVIDIA hasn't gone parabolic, it's gone vertical. Okay, and on to this week's economic data. So in the UK, we had the unemployment rate, and that fell against expectations of a rise. So it was 3.8% in April, down on March, and well below expectations. The UK employment market remains strong. And we had the claimant count for April, and that was expected to rise, and it fell. So people have been leaving unemployment and going into the workforce. You will also notice that the April numbers were revised down. So they now think the rise in the claimant count in April was lower than they'd previously reported. Bad news for the Bank of England was that earnings growth in the UK came in very hot. May, it came in at 6.5%, well above April and well above expectations. And also the April number was revised upwards. Wage growth in the UK is strong and persistent, and frankly, has been mandated by the government in that they raised minimum wages by 9.7% year on year in April. So higher inflation is leading through to higher wage growth as a matter of government policy. Now, last month, we had an extended debate about why there had been an unexpected and enormous fall in HMRC payrolls, which the number then was 136,000, which was 0.45% of all payrolls. Well, sadly, that number has now been revised to +7. So it was simply a bad number and very, very unimpressive by the ONS, frankly. So the expectations were for further falls in May, and actually payrolls rose. So further signs that the UK employment market remains strong. We also had UK GDP numbers for April, and they came in on expectations, showing the UK economy expanded. Industrial production, though, continues to be weak, coming in weaker than expectation year on year. Construction also came in weaker than expectations, but remains surprisingly positive at 3.6% year on year. In the EU, we had very little data. The only data we had was the ZEW Economic Optimism Index, which is a survey of economists, and that weakened slightly in June, but not as much as expected. Then we had some data from China, and that was all disappointing. So we had industrial production, which came in much weaker than in April. So in April, that was 5.6% year on year. In May, it was 3.5%, and that was below expectations. Retail sales also dropped sharply. In April, they were 18.4% year on year, 12.7% in May, still expanding, but not as much as expected. The unemployment rate was flat. Fixed asset investment also disappointed. Okay, moving on to the US. The small business optimism index rose slightly in May and beat expectations, but is still below 100. So small businesses in the UK and small businesses in the US are not doing great. Now, CPI, however, was reassuring. It fell sharply from 4.9% in April to 4.0% in May, and that was better than expectations. And month on month, it was only 0.1%. We'll go through the breakdown of the elements contributing to that in a while. Core CPI came in on expectations, but down on April, and month on month was 0.4%, which is still too high. Retail sales were better than expected at 0.3% month on month in May, which was down on April, but much better than expectations. Year on year, that looks solid at 1.6% up on April, but they revised down the April number to 1.2% from their previous estimate of 1.6%. Import prices were strongly negative, as were export prices. So further signs of disinflation. In this case, import and export prices are deflating. Industrial production month on month in May was poor. It was actually negative, minus 0.2%, massively missing expectations. Now, we had two contradictory manufacturing surveys. The Empire State Manufacturing index is ludicrous. It bounces around absolutely all over the place. So it was minus 32 in May. It then bounced to plus 6.6. The Philadelphia Fed Manufacturing Index is much more stable, and it actually deteriorated in June. So it was minus 13.7, pretty much on expectations, but down from May. Richard, some charts.
Thank you, Keith, for that. There's the UK unemployment rate, showing still the employment market is tight. And the UK employment rate almost back to, well, slightly above pre-COVID highs.
Yeah. Number of people actually employed.
Yeah. Showing the economy is still quite strong. Actually, UK part-time employment is rising, which we've discussed before. That can be an indicator of some stress in the employment market because employers are less sure about taking on full-time permanent employees. UK real weekly earnings have not regained where they were in, let's say, 2007.
Yeah.
We're all well off on average. We're better off. Sorry, we're worse off than we were nearly 15, 16 years ago.
Yeah, very depressing chart, actually.
Yeah, isn't it just? Well done, the Conservatives. That's going to be my mantra. We'll cheer the Conservatives every time we think they've done a good job. The estimated number of vacancies fell. By the way, I'm not a socialist. The estimated number of vacancies are falling, which suggests there is a little bit of tightening in the employment market.
Yeah. Once again, forward indicators indicate weakness in everywhere, but actually contemporaneous data shows that labour markets are tight everywhere.
I don't think they should do seasonal adjustments. I think they should simply overlay one year on the next. I think this seasonal adjustment bit is just complete nonsense.
Yeah.
There's a UK claimant count for May, showing quite a chunky drop.
Yeah, I mean, this is really unexpected. We had 2 months of rising unemployment, and it's reversed.
Yeah. HMRC payrolls reflecting a similar trend there. They've increased in May significantly.
Yeah, desperately unimpressive, though, frankly. That, last month we had this big debate about the minus 136 number. And it just turns out to have been a bad data point.
Yes, exactly. It's just nonsense, isn't it? So UK weekly earnings growth, including bonus. So we have it stable, actually, at the moment, around about 6%.
Yeah.
Which is really far, far too high.
Yep.
Although, of course, if you look at that employment, the real earnings data over the last 15 years, in fact, it's about the right level if the economy were growing, but the economy isn't growing.
That's right.
The economy is growing at half of, which depends, very slowly, if at all, yet wages are growing significantly faster.
Well, the trouble is, Richard, that, this chart is still going up. Earnings growth is still rising. And when you mandate a rise in the minimum wage of 9.7% in April, this is going to be high for a long period.
Okay, think 3 cheers for the Conservatives. UK GDP growth month on month. Well, this is 3 cheers to Conservatives, isn't it? 0.2%.
Yeah.
UK industrial production. We're doing well. No, we're not. We're doing bad. UK construction production year on year. I say, looking around London, there are so many cranes, so many large, I think the flats going up. I was reading the other day that a lot of office conversions into residential are now occurring, because obviously the demand for office space has dropped. The EU's NEW economic sentiment indicator is, and it's so volatile, this, isn't it? You could really say, as long as it's being at plus 50 and minus 50, everything's okay.
Well, what I'd say on the Eurozone, Richard, is that they're still raising rates, and a lot of the Eurozone data is looking weak. So I'm actually very impressed with Christine Lagarde in, continuing to raise rates as the Eurozone is weakening, and the fact they've just released these revised GDP forecasts, which revise downwards their economic growth forecast. So she really is prioritizing the fight against inflation.
She is indeed. EU industrial production month on month is it's really oscillating quite dramatically, but minus 3.8 last March, wasn't it? Now at +1. It's difficult to know really what's going on.
Yeah, these are big numbers month on month, actually. Suggests that their data gathering is not very good.
Yes, doesn't it? Yeah. And year on year, it's not showing signs of distress, is it, Keith? It's not leaping ahead, but neither is it out of the ordinary.
Yeah.
This is US CPI month on month, continuing this fairly rapid fall. CPI month on month, really quite low, 0.1%. US core CPI year on year, a little bit more disturbing, although it is showing a downtrend. And the core CPI month on month, fairly stable, actually, around about 0.4%.
Yeah, but too high.
Rates an annual rate of over 5%. US PPI year on year dropping fast. And month on month, also showing quite a rapid fall and trend. US core PPI year on year also dropping very fast. And core PPI month on month, an annualized rate, fairly steady actually, annualized rate of around about 3%. US supercore CPI is beginning to fall away quite quickly now, excluding housing costs. And the overall, the CPI report was soft with very few signs of inflation month on month. So looks like inflation in the US, certainly for the time being, is becoming no longer a problem, especially with the data that Keith was elaborating on at the start.
Yeah, I completely agree with you, Richard. I mean, I think this is a very soft inflation report. And you'll notice here that one of the few outliers, so where inflation rose last month, was used cars. Now, actually, we know that used car prices have been falling in recent months. And the reason there's a rise in the May inflation report is there's a 2-month lag. So actually, that's going to roll over in the next couple of months.
Yeah, so that's going to drop out as well.
Yeah.
So services shelters turn negative month on month, which suggests there's pressure on service industry's prices, actually. Me, excluding rents and used vehicles, the inflation numbers, as Keith just said, look even better. US industrial production, it is, it's actually, sort of, given that the data seems to be quite noisy, it's pretty much flat, isn't it? And year on year, there it is. It's currently at around about 0. Where it goes from here, we think it's going to. I certainly still think it's going to, that the US is going to slow down. The interest rate effect hasn't fed through yet.
Yeah.
US retail sales month on month looking reasonably happy, and year on year, they're not. What is the pre 2020 growth was around about 4% probably. 3 to 4%, not wildly different from that. US import prices year on year have dropped substantially below 0. So US imports getting cheaper. And US export prices, as Keith said earlier, just plummeted.
Yeah, I've been puzzled by this. Actually, what on earth are they exporting? Well, the prices are down 10%. That's a big fall.
I mean, it suggests either that there's a lot of competition or there's massive reduction in price pressure. I don't believe the latter. There must be to do with competition in markets.
Well, we know there's been huge deflation in commodity prices, but, the US doesn't really export that. It's not a huge commodity price exporter.
Exactly. National Federation of Independent Businesses Business Optimism Index in the US is at 90, so not terribly optimistic, has to be said. Lowest reading since around about the mid 2010s.
Yeah.
And the New York Fed Empire State Manufacturing Index, just very, very volatile since 2022. So it's hard to know what it's telling us.
Yeah.
Whereas the Philadelphia Manufacturing Index is much less volatile and is still in its downtrend, I would say, at the moment.
Yeah.
US initial jobless claims actually having risen and currently stabilized at a higher level. And there's the 4-week average, which is showing definitively sign of increasing. This is the problem with seasonal adjustments, isn't it? Seasonally adjusted, you've got that huge spike. Non-seasonally adjusted, they're flat. And I do think these seasonal adjustments are so large, they would be better off not doing them, or if they have to do them, publish the unadjusted data quite clearly so that we do proper comparisons, year-on-year comparisons.
Yeah.
US continuing jobless claims actually pretty stable around about that level for the last 3 months. Red Book retail sales in a fairly relentless downtrend, heading towards 30-year mortgage rate spiked up a little bit to 7%, but isn't showing any signs yet of wanting to go above 7. And the mortgage market index has actually just flattened completely at 200, hasn't it?
Yeah.
So it's tightened up considerably, and now it's stabilized at that much tighter level.
So, well, this is the number of mortgage applications being taken out. They're just, very low.
Well, do you believe it?
No, I don't.
But China's in all sorts of trouble, I suspect. Yeah, I mean, well, there it is. I don't believe it. Who knows?
Yeah.
And likewise, who knows? So we've still got a tight jobs market in the UK, with earnings continuing to rise, contributing to significant UK inflation. The HMRC payrolls for April was clearly rubbish, and they shouldn't have published it. UK interest rates are going to stay higher for longer to try and address this inflation problem, which we have. The EU is a little bit subdued. They've still got their inflation problem. we believe the Chinese economy is faltering. And I can't believe that they've fixed that housing problem that we've been talking about actually pretty much since we started doing portfolio matters over 2 years ago. And maybe it's starting to really rear its ugly head again. So US inflation is soft, core inflation is above their target, which is why they're being bullish about interest rates, although they haven't actually raised them. And the US economy is continuing to look resilient while retail growth continues to fall. And the economy, if they have licked inflation, then the Fed could start reducing interest rates, which suggests that the ebullience in the stock market may be to some extent justified. But if they haven't, then so all the bets are off, really.
Yeah, well, let's discuss equities later when we talk about the equity, because I've got quite a lot to say. Okay, thank you, Richard. On to one chart. Now, I thought this was very interesting, and as we've just talked about Chinese data, so this is actually data up to 2018, so it's quite old, it's 5 years ago, but you'll see even then, 87% of new homes were purchased by people who already owned a home. So essentially, the Chinese housing market is a speculative investment market. It is not driven by fundamentals. And we know that the house price to salary ratio in China is just absolutely ludicrous. It's about 30. So the idea that the Chinese can keep on propping up the housing market depends upon Chinese consumers believing that house prices will continue to rise and their investments. And frankly, I just don't think they can do it. So as the Chinese economy is heavily dependent on investment, then if they can't prop up the housing market, then the Chinese economy is likely to remain weaker than anticipated. And on to credit crisis watch. Now, the S&P Regional Bank ETF didn't really follow the market up this week, although deposits are flowing back into the banking system overall, and overall loans are positive, but not very impressive. The credit impulse will be weak, will be negative. Now, consumer loans, these are automobile loans, have been weak throughout the year, and that sort of contradicts the fact that we know car sales have been very strong. So just like housing sales, we're seeing a lot of cash buyers for cars and for houses. How long can that continue? Credit card data, though, remains pretty strong. Commercial and industrial loans, weak. So the credit impulse there is very weak. Real estate loans, though, bounce back strongly in May. Now, this is the bank deposits, and that is the yellow line, and that has bounced back, but you're still seeing lots of flows into higher yielding money market funds and CDs. The reason that banking shares haven't followed the equity markets higher is that there's still a lot of stress in the banking market. And if you look at the Fed's bank term funding program, which loans money to banks at a punitive rate, then it continues to rise. And this is the last funding measure of last resort for banks. And the fact they're turning to it means that they have run out of alternative funding options. And if you look at the Federal Home Loan Bank, that its loans to banks have also risen sharply. And this actually has worse terms than the BTFP, but there's less of a stigma for using it. So what this means is small regional banks in the US have very expensive funding, and that is going to reduce their profitability. And there is a crisis still coming, and credit availability in the US from small banks is going to be very poor. So this is loan growth, which is falling over this is 6-month annualized, whereas deposit growth seems to be recovering a bit. And bank lending in billions of dollars is slowing, not collapsing, but the credit impulse is going to be very negative, and that's negative for US GDP growth in the coming 6 months, and corporate bankruptcies in the first 5 months of the year were the highest since 2010. And the bonds and leverage loans default rate is rising, although not particularly elevated as yet. So credit availability, as reported by small businesses, is the dark blue line. We know that's been poor, and you would expect the labor market to weaken as companies struggle to obtain financing for new projects, etc. So far, the labor market has defied gravity. How long can that continue? And when we think about bank loans, the bottom line is when the yield curve is inverted, as it is now, that means short-term rates, which is where banks fund themselves, are higher than long-term rates, which is where banks lend. And so their margins are compressed, particularly if they're taking money from the Fed at essentially base rates. And it's very difficult for them to lend money profitably, so they don't do it. And that's why credit falls. And this is in the Eurozone, where this is percentage of banks reporting a decline in credit demand in Q1, and you'll see credit demand is collapsing. And turning to the UK, pause, take a look. We have our own commercial real estate problems. And in the second half of the year, we're expecting more of these real estate loans to have to be worked through. Somebody's going to have to take losses as these come for refinancing, and this will be a drag on banks in the years to come. So in summary, US regional banks remain a problem. They're turning to the Federal Home Loan Bank and the Bank Term Funding Program for expensive funding, as they've got no other sources available. And that means their profitability will be poor. Overall loan growth in the US is weak but positive, but the credit impulse will be negative, and that will be a drag on GDP in the coming months. So we're still expecting a slowdown in the US economy in the second half. Okay, on to the UK housing market. Richard.
Thank you, Keith. So UK mortgage lending is on a nasty downward trend right now. So it fell 24% as a year-on-year rate in the first quarter of 2023, and new commitments down 41%, which shows that the UK housing market is really slowing very rapidly. As we know, variable rates have risen very, very fast, and going up 2 to 3-fold actually from where they were, let's say, 2 years ago. And obviously the average rate on fixed rate loans is gradually rising to meet that variable rate. So the overall picture is that the average rate of interest paid by the UK house buyer with a mortgage is increasing quite substantially, quite quickly. So there are summary of risky lending measures. So basically, risky lending is categorized here by if income isn't evidence, it's an interest only. Variable rate mortgage, let's see why variable rate is risky lending actually. High loan, it's just lending, high loan to value and impaired credit history. So let's forget the variable rate mortgage one. So in fact, risky lending is much less prevalent actually since about around about 2016, much less prevalent than it was prior to that, which indication being that the housing mortgage price is much less likely. The variable rate mortgage has gone up like as it has, presumably because the the sudden change in mortgage in interest rates.
Yeah, but the variable rate is now 7%. So if you talk about people coming off 2% and going to 7%, that is a huge hit.
So a variable rate mortgage isn't inherently risky; it's just inherently unfixed.
Yeah.
I mean,
I know. Yeah, but anyway, it's actually quite useful data, but I completely agree with you.
So loans in arrears, actually, there's a little bit of a pickup now of loans in arrears, but I suspect that's going to go dramatically higher over the course of the next 12 to 18 months. But right now, I think we're probably just seeing the very beginnings of the sniff of the problem in the mortgage market.
Yeah.
UK house prices as a multiple average earnings. So the higher the number on the right-hand side, the less affordable houses are. And since 2000, basically the affordability is halved. In other words, it's it takes twice as much of your average earnings to buy a house now as it did 25 years ago. Yeah. And that's going to rectify itself. I would guess that is going to revert to the 1900 to 2000 mean.
Well, the other thing, Richard, this takes no account of interest rates. And so relative to wages, prices have shot up. But when you get mortgage rates going from 2% to 5%, affordability is just absolutely shocking.
Well, effectively, since 2000, we've had multiple expansion, haven't we? The multiple expansion actually has been reflected in ridiculously low interest rates, actually. And that's caused the problem. And as interest rates go up, that's going to reverse, and it's going to catch a lot of people very nastily.
Well, I completely agree with you, but we've both been entirely wrong so far in that, the UK housing market, US housing market, when you look at housing affordability, it's awful. But, the housing market seems to be remarkably resilient.
Well, I think there are two things. One is there is, as the population of the UK has increased, that has increased demand for housing. Obviously, new housing has been built, but not fast enough. So that's a sort of supply and demand issue. I think the other thing is, as we've discussed before, it's still going to take time for its effect to come through with the rise of interest rates. People falling off that fixed rate into having to refix. Presumably, they'll have to refix at a much, much higher rate, as you say, Keith. So. But I think we should hear it for the Conservatives. Presided over a disastrous plummet in interest rates. And let's give the Bank of England a hand as well.
Yeah, no, exactly.
Best UK mortgage rates. Standard variable rate is now 7. And I doubt this is really interesting. It's 7.7%. Oh, it's just ghastly.
Well, okay. So let me caveat this. Because, so I found this really interesting. So this is from manufactcompare.co.uk. And, so this 2-year fixed, actually, if you dig into it, the reason that the annual percentage rate over the life of those mortgages, 7.4%, is that you're on this teaser rate, 4.4% for 2 years, and then you default onto 7.7%. And also, there's it costs you £1,000 to get the mortgage, which is excluded from that rate. Yeah. So over the course of 2 years, you should probably raise that by 0.5% just for the cost of arranging the mortgage.
Yeah. Not great, is it? And HSBC rate's possibly more representative, and its variable rate is 7%.
The thing about the best rates in the market is they've got loads of hidden fees. And you'll see that the HSBC one is just much more honest, booking fee of 0. So you can actually calculate what the true rate is.
So UK mortgage rates rose sharply this week, and a lot of mortgage deals were pulled, weren't they? Obviously, we reissued at a higher rate. In 2023, 1.4 million households refinanced mortgages that have cost less than 2% of an interest rate to greater than 5%, which is really going to hurt. And rising UK interest rates are going to replace increasing financial stress on homeowners with rising default rates, falling house prices, but also less disposable income, which will have an effect on the rest of the economy.
Yeah.
So I've got a little bit on UK buy-to-let market. Finances for the average UK mortgage investment. So net of tax profit, if you look at, say, 2014, the net of tax profit actually was remained fairly constant till about 2022. Then suddenly two things have happened. The mortgage rates have increased dramatically. And well, actually, one thing has happened, hasn't it? The mortgage rate has increased dramatically. Everything else has remained reasonably constant. Tax has gone up a little bit. And what's happened is that the profit has got really, really squeezed at a time when your the value of your property is under threat from rising interest rates, and your repayment are likely to go up when your fix, which presumably you have, comes due for renewal. It's not a great time for buy-to-let, and also the government is mulling various changes to the letting regulations that will make, in my view, private buy-to-let really, really unappealing.
Yeah, and I'm sure everyone watching knows some friends who have bought lots of buy-to-let properties, and it's always struck me that people who don't know nothing about the stock market think it's safer to buy property because that's what they know, and it's just not. I mean, I think buy-to-let is absolutely disastrous investment at the moment. Illiquid, high fees, and very low return, and your expected capital appreciation would now be strongly negative, I would have thought.
Completely agree, Keith. Average buy-to-let mortgage now 5.8%, so probably greater than the average rental yield. Yeah, buy-to-let, UK buy-to-let is no longer a game worth playing, and you get a negligible return. And whereas previously you were relying on fairly consistent capital gain, that isn't going to be happening now. And you will experience capital loss. So not a nice place to be. Not good for the rental market either, generally speaking. Although if house prices drop, of course, more people will be able to buy as first-time buyers. So to some extent, it swings and roundabouts, with individuals suffering differently depending on their circumstances.
Okay, thank you, Richard. On to inflation watch. And okay, new policy. Top left, the dates of the next meetings of the various central banks. And this week we've had the FOMC and the ECB meetings. Next week we have the Bank of England meeting. And let's see what they do. They have lost control of the yield curve, the Bank of England. Okay, so in the US, we had inflation numbers, which were reported. So they were both good, down on expectations and down on April. We also had German numbers, and they were also good, strongly down on April. So everywhere we are seeing disinflation. Now, if we look at sticky prices, as reported in the US by the Federal Reserve of Atlanta, you'll see that sticky prices are also starting to fall. And actually 3-month annualized, those numbers look great, actually, really falling back towards the 2% target. And the inflation in May, we've already talked about how it was artificially inflated by the 2-month lag in used vehicle prices, which we now know has reversed. Well, 18% of the increase in CPI from April to May was caused by auto insurance. And again, how long can that continue rising at its current rate? Thank you very much to Wayne J on the Discord for spotting that. But wage growth in the US remains strong. Now, low-paid workers, wage growth for low-paid workers does seem to be falling, but for high-paid workers, it seems to be still increasing. And for both of them, it is well above levels which would make the Fed feel comfortable are consistent with its 2% inflation target. So is the Fed actually going to keep on raising interest rates? But if we turn to the manufacturing sector, you'll see that all the input prices are now negative year on year, apart from labor. So inflation in goods prices should come right back down, and actually this would forecast deflation. And Freight rates are back to pre-pandemic levels, showing weak goods demand. I thought this is interesting. Online prices year on year down 2.3%. And rental prices year on year falling. And we know that the shelter component of CPI lags strongly. So it's keeping CPI higher than it should be if you used actual rental prices in the market right now. And these are polysilicon prices, which have fallen by 75% in the last year. And that is an indicator of weakening chip demand.
Is that polysilicon is used in solar panels, isn't it?
Yes, that's right. But solar panel demand, I think, remains very strong.
Yeah.
It's also used in chips.
Is that to do with energy prices as well? Yeah, I'm just so curious as to why it's fallen so much. Yeah,
Not
it's
sure,
highly
Richard.
energy intensive. Oh, it uses a lot of coal, doesn't it?
It does, yeah.
And coal prices have dropped.
Yes, that's a good point as well.
Yeah.
Actually, you're right. If we step back and look at this, that just looks like the chart of coal. US trueflation continues to drop sharply. And reminder, trueflation is calculated from live prices available digitally. And it shows that actually inflation in the US really is no problem at all. In the UK, it is. I mean, UK inflation, according to trueflation, is coming down, but it remains incredibly high. Now, you expect that to drop sharply when the new utility price cap comes in. I think that's the end of this month. And we've talked previously about food prices in the UK, which remain very elevated. But the BBC had this comparison on UK grocery prices with the rest of Europe. And actually, I was surprised by the variation, but also by just how much out of line France is. France is much more expensive than anywhere else in Europe. And some of the numbers are really astonishing. So you'd expect France, with its big dairy herd, to have cheap milk prices, but actually they're double those of Spain and more than double those of Germany. And nappies, more than double that of the UK. So actually, UK grocery prices don't look like the anomaly. France is the anomaly. And if you're going on holiday to France this summer, you might want to take some stuff with you.
Take the nappies with you, Keith.
Yes. So overall, you look at this basket of 23 goods. The UK doesn't look bad. It's that the thrifty Germans who all shop at Lidl and Aldi have the cheapest grocery prices. So in some way, actually, I think US inflation looks really well set to go down towards the Fed's 2% target. Now, it may well keep interest rates higher for longer to get wage inflation down, to be consistent with that target, but we've very much got disinflation in the US. And on to recession watch. Richard.
Thank you for that, Keith. So US credit card spending has bounced back in June, which is a positive sign for the economy, although it may suggest people have struggled with not having sufficient funds and using their credit cards to supplement for that, which of course would be a negative sign.
Well, on that point, Richard, the every week we report the Johnson Red Book retail sales, which are taken from actual till data, and they show weakening spending in shops. And when you combine that with this number, it suggests to me that US consumers are turning to their credit card to fund everyday expenditure.
Yeah, it does, doesn't it? And that is not a good sign. Equity withdrawal, mortgage equity withdrawal was a huge supporter of demand in the early 2000s, but it is no longer supporting demand, and it crept back up after COVID, but it is now fallen back below zero.
Yeah.
That's clearly to do with interest rates.
Yeah.
And of course, if you do equity withdrawal, you're going to have to remortgage at the current interest rate. So young consumers feeling the pinch. So the worst off in terms of credit and debit card spending per household, or the most people who use the most, are Gen Zs and millennials, and they're the people with presumably with the lower salaries.
Well, it's retired people and old people. They're continuing spending.
Yeah, they've got more money, haven't they?
Yeah, nice index-linked pensions. Still got
living off the fat of the youngsters.
Yeah.
Global semiconductor sales continuing to fall. So that shows obviously there's a reduction in demand for semiconductors, which are pretty seminal to the modern economy, which suggests the modern economy is slowing down. Obviously, Nvidia is not suffering this from this semiconductor fall for whatever reason. And Chinese export orders, total exports, black line at the top, are falling. So they had a big splurge, didn't they, after, I don't know what that was, and then had another big splurge with the reopening. Now they're dropping back down, if you believe them. Well, I suppose we can believe the exports because we know what the imports are. Job openings getting back to normal as opposed to that sort of post-COVID. But that's what you would say is they may be getting back to normal, but they're not showing signs yet of leveling off.
So what do you mean?
Well, if they continue that trend for very much longer, they'll be showing a negative comparison.
Yeah.
So sales revenues of small businesses are falling, which shows a slowing down of the economy from their point of view.
Yeah, and the small businesses are expecting their sales to keep on falling.
Yeah, and the federal deficit is widening fast as the tax take doesn't meet the additional spending.
Yeah. Now, in one chart, why the US hasn't gone into recession.
Yeah, that's right. As we discussed last week with infrastructure spend and so forth.
And actually, I listened to a very good podcast during the week, which was talking about how the US government during COVID gave a lot of money to the states for infrastructure spending, and there was a time limit on that spending, and they still haven't spent most of it. So, although the money has been accounted for in the deficit, that spending is right now pushing up demand for construction. And, that's why the US is not going into recession.
Yeah, exactly. So inventory sales ratios are rising, which presumably means some form of destocking is going to be on the cards shortly.
Yep.
And US durables inventory sales ratio also rising. So further reductions in new orders from manufacturers to be expected.
Yep.
So that suggests there's going to be a slowdown in manufacturing. So rail transport is up on last year. It's not anywhere near where it was in 2021. What do you think about this chart, Keith?
Well, I find this interesting, but this, which is container traffic, shows it's well down on 2022, which means that they must be transporting a lot of other goods like coal or commodities around the country. But this certainly indicates that goods demand is well down on the previous couple of years.
So I saw a chart this morning actually on something where it shows that cardboard box demand in the US is below the levels it fell to at the GFC.
Yeah. Now we showed the cardboard box chart last week actually, but I didn't realize it was down on GFC levels. Okay, so this is US pending home sales, and not only are they down on last year, but seasonality would seem to suggest that home sales in the US have actually already peaked.
US home buyers still managing to buy houses. I don't. Doesn't that look delightful, Keith? I can see why they want to buy it.
Yeah. Well, I find this absolutely amazing. We know that housing affordability in the US is terrible. So how are people managing to buy these homes? I just don't understand it.
No, it's one of those time will tell things, isn't it? Eurozone exports year on year are falling very fast, actually. And that's unlikely to stop at zero, isn't it, given that rate of decline?
Well, it's actually below zero.
Sorry, quite right. It's unlikely to stop at the dotted line where it is now.
Yeah, but I mean, so in March, it was plus 7.2% year on year. In April, it was minus 3.6% year on year. So that suggests either there's been an enormous base effect or a rapid slowdown in exports from the Eurozone.
Yeah. Watch this space. We need a bit more data. Well, that's consistent. Dutch industrial production collapsing. That's really nasty, that chart.
It is. Yeah.
What is the Dutch make apart from etching machines? But that is
EDAM.
nasty. Is that industrial production? That's farm production.
Not the EDAM you get in Iceland. It's not. It's definitely industrial production. But Christine Lagarde is continuing to raise rates. I'm very impressed with her.
She's okay. She's paid by the central bank. So global manufacturing sector is weak and still weakening. US economy, as we discussed last week, is being supported by this enormous fiscal largesse, but that isn't occurring really in Europe or the UK. We know, we say ceaselessly, boringly, that monetary policy is working with a lag, and boy, is it working with a lag. So we still expect to slow down. The US credit crunch is still on the cards, hasn't gone away, and the commercial real estate sector is undoubtedly in trouble. What's that going to do to the banking sector?
Yeah.
Will the US escape with a shallow recession? Well, the problem is that the government, what happens when government spending ceases? They are debt to GDP in the US is too high. And so I don't know whether they're sowing, possibly, but they may be sowing the seeds of the next problem as well.
Yeah, I mean, what we have missed, and I've been calling for a recession for a long time in the US now, is just the scale of US fiscal largesse, which has supported the economy much more than I expected. And it's clear that they're still pumping it out. The deficit continues to rise, even though the US is not in a recession. And so, you've got the fiscal policy supporting US growth, even as the Fed tries to slow the economy.
Yeah, exactly.
Okay, briefly onto El Nino. So I thought this was interesting. This is the surface temperature anomaly in the North Atlantic. And that is at extreme levels this year. So expect extreme weather events in the North Atlantic. Sadly, that's where we are.
Yeah.
Reminder, we showed you this before, but El Nino is when you have high surface temperatures in the seas, and that prevents cold water coming up from the depths. And they tend to be both El Nino and La Nina tend to be self-reinforcing. So expect a hot year. And that could lead to hot and dry conditions, drought in Europe. We've got El Nino conditions this year, and the surface temperature anomaly in the North Atlantic really is extreme. Okay, and on to other charts. Richard?
Thank you, Keith. There's a sex ratio in China by age group, which shows that there's quite a significant male-female imbalance and one in with more males, like 16%, so 15, 14, however many percent it works out at, percent more males than females, which is a really unfortunate. And I knew there was an imbalance caused by the one-child policy, but this can't be related to one-child policy, can it, Keith?
No, they're because of cultural reasons, they value boys more than girls, and so they were selectively aborting girls. Now they seem to have really managed to cut down on that now, but there's all these cohorts of young Chinese men with not
you won't be able to find
women.
A partner, yeah.
And the trouble is, they're approaching the age when they're entering the workforce, looking to get married, but also when they're most violent. And actually, a book recommendation for everyone. This is a book I really enjoyed, The Weirdest People in the World by Joseph Heinrich. And in that, he reports various studies where it shows that marriage is very good for men, leads to higher levels of reported happiness, better health, and for society, lower levels of violence and criminality. Lots of sexually frustrated young men is not good for the crime stats. And when we think about the sex imbalance in China, that's not good. Lots of sexually frustrated young men. And this is actually the data from England and Wales, which shows who commits crime by age and sex. And you'll see that vast majority of crime is committed by young men between the ages of 15 and 30. So in China, you've got a lot of sexually frustrated young men in the peak crime and violence age.
I'm pleased to see, Keith, that you're well past your criminal years.
Yeah, I put all that behind me, Richard.
So China's freight index has returned to pre-pandemic levels, i.e. the price of freight.
Yes.
And so that's good news for everybody. Removes a big source of inflationary pressure. This is just showing that Chinese floor space sold is not looking very healthy, which is what we suspect the Chinese property market is in trouble.
Yeah. And it's the lowest. Floor space started as the lowest since 2009.
Chinese fixed asset investment, as we will discuss this a little bit in the introduction, is falling. We don't know how much to believe the data. It's a lovely straight line. And here we have the real estate investment, which even if it's fixed, it's going to be worse than that. But if it's not fixed, it's pretty dreadful. So. And US CEOs have had a very good 40 years. And since the advent of them being basically having their remuneration linked to earnings per share, which they have the power, capacity, and willingness to manipulate hugely in order to maximize their returns above anyone else's return. And they've done it really successfully.
Yeah. I find this really shocking in the US. Average CEO, 400 times the average worker. Yeah. And do you think that US businesses are better run than they were in the 70s or 80s? 10 times better run? No. It's just been a huge wealth grab by the executive.
Yeah, completely. Financialization of the economies.
Yeah. And on that depressing note, on to good news. And actually, this is a total corker. Forget about everything else in the weekly this week. If you only remember one thing, drinking is good for you. So, German hospital surveyed 628 people over 60s who came in for minor surgery, and they followed them and see how they recovered. And the people who put themselves in the category of drinking potentially unhealthy quantities of alcohol, which meant drinking at least 4 nights a week and regularly consuming the equivalent of 2 bottles of wine in a day, they were slimmer, happier, and more mobile than people who drank less or were teetotal. Great news for you and I, Richard.
There we are, Keith. You
Now,
saw it here first, everybody. Go out and have a good drink.
Exactly. Now, the
but exercise.
Yes, and exercise. But the British doctor who was commenting on this study said, higher self-reported quality of life may be the cause of unhealthy alcohol use because those in this group who are healthier can then socialize more and drink greater amounts of alcohol. Okay, so what he's saying is the causality is the other way around. Healthy people can socialize more, and being more sociable can drink more. But I think there's a decent chance it's the other way around. You know, drink yourself to better health, says Portfolio Matters. Don't sue us. Equities, Richard.
Thank you, Keith. So the FTSE All Share basically bumbling around, no change for the year. The stocks Europe, it's just nearly 10% up for the year, which is pretty good. The S&P 500, of course, doing jolly well on the basis of not very many companies. And the NASDAQ soaring ahead again on the basis of those big 8 tech companies, now up nearly 32% on the year to date. Won't be far off doubling if it carries on at this rate in 2023. Who would have believed it? So the Hang Seng, again, really unchanged for the year. The Topic's doing pretty well, actually, up 3% for the week, nearly 22% for the year. Bitcoin down a bit, but still over 50% up for the year. The pound having a good little run, or you could say the dollar's having a bad little run at the moment. So the pound and euro both up significantly on the week, and pound up nearly 6% on the year, which is good for UK inflation, in fact. So then we have the dollar index down 1.2% for the week and the year, and the VIX was up 6%, although still down 33% on the year.
Yeah. And I still have my short on the S&P 500 on at £1 a point, and I'm going to keep it until it hits, VIX hits 25, and it's not looking very clever. But it is a trivial amount of money.
Got to give it a go.
Yeah.
So the S&P 500 as a cohort is on a price earnings ratio of 30, which is steep.
Yeah. You know, and that people are talking this is the start of a new bull market. You know, valuations are too stretched. I just don't, you know, how can you have a bull market starting at 30?
Yeah. Well, these days, Keith, you can have anything you like.
Yeah.
Just ask the central bank and they will print it for you. In the aftermath of .com, the S&P rallied 21% in 104 days, and then it fell 31%. So be careful is the message. And in 2008, it rallied by 24% in 47 days, and then fell by 27% thereafter. So you do have to be careful.
Yeah.
But we have very bullish investors. We're talking about US investor sentiment here. Bullish US investor sentiment, both for active managers and for sentiment.
Yeah. And the CNN Fear and Greed Index is in extreme greed.
Retail has bought the rally. That's the pink line that's popped up to that very high level. And so retail is going all in.
Yeah. And this is almost invariably a bad sign. So last week we reported that 98% of companies in the S&P 500 reported Q1 earnings, and that sales growth had been an impressive 9.1%, and EPS growth 6%. But both those numbers were per share. And actually, if you look at the absolute numbers, then revenue growth was 3.6% and earnings growth was minus 2.9% in absolute terms. So bottom line is corporate earnings have declined as we were forecasting they would. But because they've been doing so many share buybacks, they've more than compensated for the fall in earnings by reducing the number of shares.
Mm. And we've got equities defying the interest rate rises. So we just see that the green line of the S&P has totally diverged from the US Treasury yield.
Yeah. Again, normally you would expect the yield on equities, the earnings yield on equities, to be highly correlated with interest rates, because it makes no sense. Go on.
This is presumably the market is expecting that the Fed is going to cut interest rates fairly quickly, fairly soon, and therefore they're preempting that expectation. Quite a dangerous thing.
Mystifying to me.
Yeah, and it's speculation. As earnings highly correlated with US economic conditions, so US economic conditions are declining, so you would expect earnings to decline.
Yeah.
Future earnings.
And to be clear, I'm expecting in the second half earnings to decline. So actually, probably a year ago, 18 months ago, we did a special section, and there is a separate podcast on the best predictor of US equity returns. And it is the allocation to stocks in investor portfolios. Now, go and if you haven't seen that, please go and watch it and explain this. But what it shows is that the future returns of the S&P 500 are highly correlated with the stock allocation of US investors. And every so often we update this chart, and what it's showing is, according to that, the returns over the next 10 years for the S&P 500 are going to be a highly indifferent 2% per annum.
Grab it while you can.
Yeah.
Where next for equities? S&P 500 index, and what's a YRI forecast?
I don't know. It's just forecast, Richard. I mean, these are technical forecasts, but this is an excuse for you and I to have a chat about what we think is going to happen to US equities.
Oh, right. Okay. So I think that US equities are going to, I don't know, actually. And the reason I say I don't know is I know what they ought to do, which is drop. But the world is so weird that I don't know whether they will.
Yeah, no, well, I completely agree. But, frankly, I think we're in this melt up, and that's going to come to an end. It all requires on money flows. And, we've just got way ahead of ourselves. And actually, the second half earnings are going to be negative. I'm very sure of that. He says, having been very sure of it for most of the year, but,
Well, at some point, you're going to be right, Keith. I don't mean that, I think you and I are of one mind here. It's just taking a long, long time to come through.
Yeah.
Okay, so we're in a bull market as defined by 20%.
Yeah.
And tech stocks are back to their 2021 highs. And there we have NVIDIA's valuation. And it's price earnings ratio, which is somewhat paltry, given that.
Well, if you buy it at these levels, you get absolutely what you deserve. You're buying it as a speculation. That there's no way on earth it can justify this. So, how long can that continue? So,
long big tech is the most crowded trade. Actually, and it has become hugely more crowded in the last few weeks.
Yeah, and you see that actually the biggest, previously, it was short US banks.
Yeah.
They've totally rode back on that and switched into tech.
Yeah.
Okay, thank you, Richard. And on to commodities and energy commodities. And it was a volatile week for oil, but it closed up only 0.5%, and actually WTI closed down. So oil not really participating in the market euphoria this week. Europe, we had a big bounce in natural gas prices. Now, there are two reasons for that. One is we're having a heat wave and air conditioning demand has gone up. So power demand's gone up. But the other piece of news was that the Dutch are going to close the Groningen gas field, which they had been planning to do pre-invasion, but they kept open. And the Groningen gas field is associated with earthquakes, basically, in the Netherlands. So they're closing it for that reason. But that means that the gas supply situation in Europe will tighten, hence the bounce. US natural gas prices also had a bounce, up 10% on the week, but still down 42% on the year. Coal was flat. Uranium had a great week, up 6%. Numbers specific to the oil market, very interesting. Well, we had a big build in the US of 12.1 million barrels if you exclude the SPR. Now, what's interesting is when you include the SPR, the build was only 10.3 million barrels because the US is now refilling the SPR. And actually, that's been a good piece of business for the Biden administration because they sold oil from the SPR when oil prices were higher, and then now they're buying it back cheaper. Energy Department as a hedge fund. So US crude production was stable at its new highs for the year of 12.4 million barrels, and Baker Hughes rig count ticked up 1, though it's still down 65 on the year. This is Brent, pretty stable. Now, we had OPEC crude production numbers for May, and they're saying crude production fell by 770,000 barrels a day, and that is largely due to Saudi Arabia. So this breaks it down further, and you'll see it's basically Saudi Arabia and Russia. And has Russian oil production now started to fall? Are sanctions starting to bite? Although its seaborne exports are still well up on last year. And as we've discussed, the Biden administration has started to refill the SPR. Okay, now I've got a special section on US shale. Now, the Goering and Rosenzweig had a report out this week talking about US shale productivity, and it is down. In 2022, it fell for the first time. The most productive areas of the various shale basins now appear to have been drilled out, or increasingly drilled out. And that matters because, as you can see from this chart, the majority of US oil production is now shale. So falling shale productivity implies that the US is going to find it difficult to grow oil production in the coming years. So if we look at the big three shale basins, the only one still growing is the Permian. But in the Permian, productivity is in decline as well. And you can see why here. The core of the Permian, the best, most productive acres have largely been drilled out. There's a bit left, but now increasingly have to drill in tier 2 and other areas. So most productive areas of all the big shale basins are now being exploited. So when a shale basin approaches 50% of resources recovered, then growth tends to stop. And that's what's happened in the Bakken and the Eagle Ford. And in the Permian, there's still space. So the Permian still has growth potential, but it is the only one left, and productivity is in decline. Now, having said all that, technology could yet come to the rescue. So last week, Exxon were discussing at their conference how they believe new technology will allow longer lateral well segments and them to keep fracks open for longer, and so to get more out of each well. And the history of the shale industry has been increased productivity, and the whole shale revolution is a technology revolution. So although the geology is now working against higher output from US shale basins, I wouldn't underestimate the industry. We'll just have to see what they can do. If they can improve recovery rates, then you could still see growth from US shale. Okay, moving on to European natural gas futures. Had a bounce this week, but today that bounce is fading again. And US and falling EU gas prices have failed to revive industrial demand in Europe. You see here, European companies have become more efficient in their energy usage and are not using as much gas as they did. These are UK natural gas futures. They followed Dutch ones higher. Good news. In May, the EU produced more electricity from renewables than fossils for the first time ever. And that trend is only going one way. So the big question is how you can integrate renewables, which are intermittent, with the grid where demand follows regular patterns. US natural gas prices ticking up a bit, but still towards their lows. Coal going nowhere. Uranium, my God, off like a rocket. Perhaps all my cynicism has been unjustified, Richard. We'll wait and see what happens when they reopen some uranium mines. This, though, is bullish. So this is as of December 2021. This is the pipeline of new nuclear power stations. China is building a hell of a lot of them. And for the world, that is great news. That means they'll be cutting down on coal. And, when I see Greenpeace in the UK, arguing against nuclear reactors, I mean, the green lobbyists have just totally lost the plot. They want us to go back to the Stone Age. We need energy, and this is the best way of getting it.
I completely agree, Keith.
On to industrial commodities, Richard.
Thank you very much, Keith. So aluminium, quite weak, really quiet year, actually, just down a little bit on the year. Cobalt unchanged this week, but a big drop this in the year. Copper up 3.2% on the week for reasons that are beyond me. I know copper is in a structural deficit over the coming years, but it's not behaving as it were at the moment. Chromium, not very much change on the week. Iron ore up 4% on the week, which is big, but unchanged on the year. Lithium carbonate still continuing to rise after that rapid fall that it experienced earlier in the year. Neodymium down 35% on the year. Nickel up 8% on the week. So something, nickel, copper, iron ore, big moves, and tin and zinc, big moves on the week. For reasons I actually don't know.
I think this is all, soft landing. So Fed's paused. The market, the commodity markets believe that we can have soft landing, and that's good for industrial demand. But that is speculators. We'll have to see what actual demand is.
Yeah, I'm sure you're right, Keith. That's a good point. Some charts is aluminium, cobalt, copper.
Dr. Copper recovering.
Yeah, very true. Chromium, iron ore.
Yeah. Now, if the Chinese fixed asset investment is not recovering, then you'd expect this to roll over. But the Chinese are contemplating further stimulus measures. So let's see.
Yeah. Lithium, neodymium, a nickel, sharp spike there.
Yeah, it has a history of sharp spikes, rapidly unwound.
Yes. Tin, ferrovanadium, and zinc.
Now, actually, when we talk about tin, tin's mainly used in semiconductors, and we know that semiconductor sales are falling. So, I think this is speculation.
Yeah. So precious metals, gold pretty much unchanged on the week, 7.5% up on the year. Silver unchanged on the year now. Platinum 3% down on the week, 7% down on the year. Rhodium 1.6 down on the week, but halved over the year. And palladium up a little bit on the week, but down 22% on the year. So fairly unremarkable week for precious metals. So then we have gold, silver, platinum, rhodium.
Looks awful,
Doesn't it just, yeah. And palladium.
Thank you, Richard. And on to rates now. Really interesting week in the UK. So we had very poor wage growth data, i.e. wages were much stronger than anticipated. And that implies inflation is going to be persistent, and the Bank of England is going to have to raise rates higher for longer to get inflation under control. Now, the market reacted by increasing yields at the short end, but the long end didn't move and actually fell at very long rates. So what that implies is the market now believes that UK short-term rates are too high for the economy to stand, and the UK will go into recession, which will bring inflation down, and in the long term, inflation will head back towards target. In Europe, yields are pretty stable over the course of the week. So this is the spread between gilts and treasuries, and you can see the spread is positive. It was negative for many years, but now it's turned positive, and it's the highest it's been for a long time, higher than after the Truss mini budget. So the UK is losing the trust of the bond market. The bond market is demanding a substantial premium over the US to lend to the UK, whereas previously it used to demand a premium from the US. So the UK 2-year still rising, 10-year towards its highs, 30-year though, stable. US 10-year is going nowhere, not coming down yet. German Bund yields are still rising, which is surprising given the slowdown in the German economy. This is Italian, Greek. Any change to your views, Richard? Equities are defying all of this and doing very well.
No change to my views there, Keith. Any to yours?
No, I mean, we have been collectively really wrong on US equities. UK equities have done nothing really, but US equities have been amazingly resilient, and tech, which is, I never touch because it's just completely unpredictable. And basically it's a speculation. It's not an investment. There's just, completely gone through the roof. And when you see the share price of NVIDIA, medium term, it's idiotic, but short term it's done really well. And, the top 10 in the US have performed incredibly well. Yep. So short term, I think it could go anywhere, but medium term, when things get this far out of line, they have to come back into line. And people dislike losing money more than they like making theoretical money. So in summary, the Fed paused this week, and that has led to a renewed bout of confidence in global equity markets, all of which had a good week. And commodity markets also had a good week on general improvement in confidence and hopes for Chinese stimulus measures. But as we've talked many times, and frankly, we've got this wrong all year, equities should see slowing earnings growth or negative earnings growth in the second half of the year as the lag effect of rising interest rates starts to take effect, and it's being supported by a ludicrous bubble in tech. And it seems that AI is the next .com. And, you just, at some stage, all these prices of NVIDIA, et cetera, will come back down. But, where could it go in the short term? Could go to the moon. I mean, when it's on a P ratio of 200 plus, could go to 600. It's just daft.
Yep.
Anyway, what have you been up to this week, Richard?
Nothing, Keith. As usual. I haven't bought anything. I haven't sold anything. I'll be sitting on my hands. I don't expect to do anything for a while, actually. So precious metals, a little bit of uranium miners, and a few industrial commodities will take advantage of the electrification of the world. But I haven't made any changes at all. I'm being very, very inactive.
Very good.
How about you, Keith?
I had a much, much better week than expected, actually.
Oh, good.
I was up. When I saw the earnings numbers for the UK, I thought I'm going to get absolutely taken out. But short-term yields in the UK shot up. Long-term yields actually came down.
Yeah.
And so I'm still having a terrible year, but I'm increasingly confident that, it's going my way. And I just wouldn't buy equities at this point, because the risk reward, it just seems awful to me.
Yeah.
No buys, no sells. Now, let's talk about TR24, which I have been saying on this channel is a very good cash alternative. So according to the Debt Management Office website, TR24 yields inflation plus 1.93%. And reminder, it matures on the 22nd of March next year. Now, why has the price been falling? So if you look at conventional gilt, which matures next year, so actually this is the 31st of January next year, but within a month and a half, that is yielding 4.92%. So with and without inflation, these two instruments should yield roughly the same. So therefore, TR24 is assuming inflation over the period, RPI, of around 3%. But we featured this last week. The forecasts for RPI for the end of this year are that RPI will be about 6.3%. Now, highlighted December because there's a 3-month lag in the indexation of index-linked gilts. So in March next year, you'll be getting December RPI. And we can actually work out, based using the 6.3% forecast, what RPI should be over the coming months, according to that estimation, based on the fact we already know RPI for the first 4 months of the year. So in order to get 6.3% annual RPI by December, RPI needs to average 34 basis points over the remainder of the year. Now, in June, you will be getting March RPI. July, you will be getting April RPI. And the far right-hand column shows the compounding of RPI to maturity in March. Now, to simplify the whole thing, I've assumed you get the whole of June and the whole of March. And obviously, we're most of the way through June now, and you only get part of March this year. But you can see over the coming months, these are 9 months, 10 months, then you will get 5% from the indexation alone, assuming that RPI is 34 basis points a month from May to December. And You'll also get return on TR24, which earlier in the week was at when I did this was at 98.6. So you get 1 over 98.6. So that's another percent odd. Plus you get the coupon. And so that gives you a total return over those 10 months of 6.6%. And so annualized, that's really good, frankly. And also, we're assuming that if RPI comes down to 34 basis points a month on average over the rest of the year. And we know that wage inflation has been elevated. And do we really believe that RPI is going to come down that fast? Actually, RPI has been persistent. I could easily see this being exceeded over the remainder of the year. So bottom line is, I don't know why the price of TR24 has been falling when the indexation component has been rising. So the difference between, it seems to me, TR24 is a vastly better buy than TN24, which is the conventional gilt. And finally, so this is Jadestone Energy, which we did a share talk on back in the day, and I sold last year back in May, and I sold it at just over £1. Well, it has had problems since then, and reminder, it buys old assets in Southeast Asia and tries to increase their production. Now, the danger in that policy was that you're buying old decaying assets and, they rust and you need to do maintenance on them. And they have had a few problems on their Montara field of Australia. But what they've done this week is they have announced they've taken funding from private equity and they've issued shares. And in order to, as part of the deal for the funding, they have hedged half their production at $70, which means they've given up a lot of the upside. So the danger of these small oil companies is, what are the terms of the funding when they need money? And, because they've had reduced production, they haven't had the cash flows they've expected. So funding is expensive and very bad for existing shareholders. So just goes to show once again that in buying, these small oil companies, sometimes it is best to take your profits when the going's good. Okay, and that is it. Thank you very much for watching. Please can you press like and subscribe to the channel and enjoy the summer. It's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.